You've heard the pitch 100 times. Palantir is the future of AI. Tesla is going to dominate everything. Applied Digital is the next big data center play. So why aren't these stocks living up to their hype of late? The answer is pretty simple. The fundamentals just don't support purchase at this time. For me, the best way to analyze the fundamentals is through our proven quant model Zen ratings. Every day we analyze more than 4,600 stocks across 115 different fundamental factors. Then we assign an intuitive grade, A to F. The higher the grade, the higher the likely share price outperformance in the future. And all these popular stocks, they mostly rank as middle-of-the-road Cs. Not bad, but not great either. Meanwhile, we found 5 undervalued stocks that most investors have never heard of. Each of them scoring the top 2% of all the stocks we track in the Zen ratings model. In fact, one of these stocks just posted earnings that nearly tripled year over year, and yet is only trading for half of its fair value. Another stock we will discuss today is just 1 to 3 companies on the planet that produce something every major AI chip literally cannot function without. And demand is so high that their entire 2026 production is already sold out. And by the way, I'm Steve Reimeister. It's been over a decade as editor-in-chief of Zacks.com, and now I'm a partner at WallStreetZen.com. Now, before we dive in, go ahead and hit that like button. It's going to help more data-driven research just like this pop up on your YouTube feed in the future. Now, let's start our stock countdown with Digi International with the symbol DGII. This company provides the networking hardware, software, and managed services that connect industrial devices across critical infrastructure. Think factory floors, hospital systems, energy grids, and complex transportation networks. These are places where downtime is not an option. As AI gets pushed to the edge, these are all important deployments depending on the kind of connectivity that Digi supplies. Now, here are a few more reasons I took note of the company. Now, earnings have grown 87% over the past 3 years. The earnings growth is not a fluke. It's a result of recurring subscription revenue, continually compounding in a market that keeps growing whether anyone is paying attention or not. On top of that, Digi has beaten estimates for 16 consecutive quarters. That kind of consistent earnings momentum generally points to more good times ahead. And overall, the company has a cleaner balance sheet than most tech companies with 10 times the YouTube coverage. Yet most investors who screen for stocks have never even heard of this ticker. Past earnings growth is nice, but investors generally pay up for the growth they expect to come in the future. And on that front, Wall Street analysts predict another 53% earnings growth this coming year. Now, speaking of analysts, right now, 5 analysts in our system are issuing ratings. Of that, we have 3 strong buys, 1 buy, and just 1 hold. That is pretty strong bullish consensus. Looking at the Zen ratings, Digi International ranks in the top 2% of the stocks we track for fundamentals. Now, this earns an overall rating of A, which also implies a strong buy recommendation. Dialing in the component grades that shape the overall rating, we see they score in the top 20% of all stocks for 3 key areas. We're talking about growth, safety, and momentum. Value is not a strong suit, but not too shabby either in the top 25% of all stocks we track. Now, this is a buy high, sell higher pick, meaning that quality stocks that keep beating earnings rarely go on sale. But because it's still flying under the radar, then as it pounds out more earnings beats in the future, no doubt other investors will be summoned to these shares, leading to amp performance. Now, before the next pick, if you're not subscribed yet to this channel, then hit that button and the notification bell right now. That's because we put out research like this every single week. Stocks our system is flagging before the crowd discovers them. Those who subscribe won't miss out. Now let's consider tech stock number 2 in Mitek Systems with a symbol of MITK. Now, this is the invisible infrastructure behind mobile check deposits. When you photograph your check in your banking app, there's a very high probability that Mitek Technology is processing that image. More importantly for the growth story, Mitek's platform powers digital identity verification and KYC compliance for banks, fintechs, and online lenders globally. As financial services move more online and anti-money laundering regulations tighten, that digital identity capability becomes all the more essential over time. Now, Mitek earns an overall Zen rating of A and currently sits in the top 1% of all stocks we track based upon that 150 different factor fundamental review. But one key area I want to focus on is sentiment. They are strong in virtually every area, but the standout is their sentiment score in the 96th percentile of all stocks. This means the smart money is already lining up behind these shares. Remember that institutional money moves early. These guys don't wait for retail investors to show up. That's often a sign the party is over. So when you see a sentiment grade this high on a $13 stock that has not appeared in a single trending YouTube thumbnail, all right, the question worth asking is what these guys know the broader market has not yet priced into these shares. The numbers back up the institutional thesis. That's because earnings are up nearly 290% year over year. That is not a typo, right? The Zen Ratings sees this earnings prowess with their growth rating in the top 6% of all stocks we track. Value is another area of strength given a forward PE of only 9, which is ridiculously low for this level of growth. And across all 21 value metrics in our model, it scores in the top 16% of stocks. In plain English, these are very undervalued shares. This is a case where it appears the data is ahead of the price, and the smart money has already sniffed it out. Gladly, there's still time to get on board Mitek before the stock becomes much more well-known and with a much higher share price. Now we've made it into the halfway point with our third pick in 8x8 with the symbol of EGHD. Now this cloud communications platform helps enterprise customers manage voice, video chat, and more on a single system. The markets they operate in are projected to grow into the hundreds of billions, and while the top line has been a tad soft, the business has been shifting towards large enterprise accounts with higher margins and higher lifetime value and lower churn. At under $5 per share, it's considered a penny stock. And as a result, many investors just scroll right on by, which is a grave mistake. That's because we're talking about a stock with a truly stellar fundamental profile. It's not just A-rated in our model, it's actually in the top 1% of all stocks. Truly rarefied air that generally points to stocks likely to outperform. One look at the component grade ratings and you'll understand why it's on the list. Let's start with a value grade of A, putting in the top 5% of all stocks. Its price-to-sales ratio is shockingly low at just 0.38. That kind of structural undervaluation only exists when the market is completely overlooking a company. The growth grade is a B, but it's teetering on the edge of crossing into A territory, being the top 6% of stocks. This statement of the consistency of earnings generally points to more earnings beats on the horizon, which generally boosts shares. The AI factor grade is another A. That signal uses machine learning trained on more than 20 years of market data to detect early patterns of future outperformance. It's a signal that's worth paying attention to. Right now, we only see one Wall Street analyst covering this stock. That is Catherine Trebnick at Rosenblatt, who ranks in the top 15% of all Wall Street analysts by her verified stock picking performance. She has a strong buy with a price target that forecasts over 60% upside in the year ahead for these shares. Now, the risk here is direct. If revenue stabilization and the path forward to profitability do not materialize on schedule, then this bullish thesis does not work. So size your position accordingly, given that it's more of a speculative stock. Before we get to the last pick in the video today, a little quick reminder. Every Monday, I share my stock of the week with investors. This blends the outperformance found in the Zen Ratings quant model, along with my greater than 40 years of investing experience. So get my future stocks of the week for free by clicking the link in the description or scanning this QR code. Okay, the next stock on this list is the name that most of you will recognize, and that's kind of the surprise of this video. The market knows this company well, but the data still says it's completely mispriced, and that spells opportunity for us investors. Okay, without further ado, stock number 4 is Micron Technology with a symbol of MU. Everyone talks about NVIDIA. Fewer people talk about the company whose product NVIDIA chips literally cannot work without. I'm talking about Micron's high bandwidth memory, also known as HBM chips, right? Every AI chip built today, every next generation accelerator from every major manufacturer requires HBM to function. There is no workaround and there is no substitute. Only 3 companies in the world can produce it at scale. And we're talking about Samsung, SK Hynix, and Micron. And Micron is the only one based in the United States, which is important for the supply chain. Demand for Micron's 2026 production capacity is already fully sold out. Let me say that again. Demand for Micron's 2026 production capacity is already sold out, and we are having this discussion in April. That means incredible pricing power and higher margins. It also means higher visibility into the growth that lies ahead in future earnings reports. Here is the structural position looks like in the numbers. Earnings for the trailing 12 months have grown by over 400% year over year. For impressive as that is, the PEG ratio, which measures the price you pay relative to the growth you're getting, that sits at a shockingly low 0.35, meaning Micron is still considerably, unbelievably, and insanely undervalued. 25 Wall Street analysts track this stock, and it's a formidable group including highly ranked analysts like Tom O'Malley of Barclays. Now, Tom is in the top 1% of all analysts based on his historical stock picking performance. Or to put it another way, Tom is a heck of a stock picker. And right now he is pounding the table that Micron has 50% more upside in the year ahead. Other analysts see it going even higher. Indeed, Micron scores well in the Zen ratings model. It's not just A-rated, which implies top 5% of all stocks. It's even better than top 1%. We're talking about the top 0.3% of all 4,600 stocks that we track. Here we have a wealth of high marks across the component grades. We're talking about A grades for value, growth, financials, and sentiment. That combination is rare, and yes, it's extremely attractive. With that said, the safety grade for Micron is a D because of the high volatility that comes with being in the semiconductor industry. That may not be a big deal for more aggressive investors, but for those of you on the more conservative side, you may not enjoy the daily highs and lows of these shares. Now, the infrastructure moat for Micron is as impressive as any stock I've ever covered. Couple that with the soaring demand from AI build-out, and it's truly a spectacular fundamental profile. Then you completely understand why these shares are on the buy list today. I'll let you also know that I added Micron to my Zen Investor portfolio in December 2025, and it's up already over 100% in that short period of time. But what matters now is the future potential looks like. So when you add up the growth and value picture for Micron, it bodes well for more upside ahead. And that is why I continue to recommend the stock to new investors today. Let's close out our conversation with Diebold Nixdorf with a symbol DBD. This is the second highest ranked stock in the entire Zen Ratings universe. This might seem like a weird follow-up to a dynamic stock like Micron, but there's an exciting angle here to its investment profile. So let's start with what they do. This is a legacy company that's over 150 years old. Their bread and butter is providing services to help banks and retailers run ATMs, payment systems, and self-service checkout technology. Now, no doubt you're letting out a big yawn right now, so let's get to the good part. The company just came out of a significant restructuring in 2023, and when they did, they focused on something new and completely different, the software layer running on top of the hardware. And yes, the turnaround is working great, just that investors continue to be asleep at the wheel on the stock, and that gives us an opportunity to act now. Their DN Dynamic platform is becoming the operating system for how consumers interact with physical banking and retail. Self-service banking, cashierless checkout, unified commerce across in-store and digital channels. Every bank and retailer modernizing their physical infrastructure needs this capability, and there are not plenty of places to get it besides Diebold. The turnaround is visible in the data where DBD earns an overall Zen rating of A, which implies a strong buy recommendation. Yet as shared up top, this is actually the second highest rating stock in our universe, so maybe it's better to say A+ with these shares. Looking at the component grades, there's even more to like about these shares. Growth is another strong suit in the top 1% of this vital category. This rating is more about the consistency of growth across earnings, revenue, cash flow, EBITDA, and profit margins, yet we can still be impressed by the estimated 115% earnings growth on track this year. Sentiment is another feather in their cap for Diebold, sitting in the top 2% of all stocks. As shared earlier, this is our smart money signal, as these pros often catch wind of future winners before the average investor has even heard the name. And thus good for us to act when it finally crosses our screen. Right now, only two analysts cover the stock, one with a strong buy, the other one with a buy rating. You may be concerned by this light Wall Street coverage, but let me assure you this is actually a positive, meaning that when you buy under the radar stocks like this, then at some point in the future, other analysts will join the party. Each new buy rating is a catalyst for shares to bolt higher. Let's look at the other component grades. Value clocks in with a strong B rating, the top 10% of all stocks. The keys being the price to sales ratio of only 0.66 and the price to earnings growth ratio of 0.33. Both incredibly cheap any way you look at it. On its own, that's enough to warrant a closer look. But remember that it comes packaged with that A rating for growth. Momentum and safety also come in with B ratings in the top 20% all stocks. The one area to watch is financials, which is only a C rating. That's because the balance sheet still carries debt from the restructuring period. What alleviates that concern for me is a pattern of strong execution in the last 3 quarters. Let's knock it out. We're talking about serious earnings beats. First, they came in 62% beat. Hooray! Then 49%. And that wasn't good enough. Then the most recent quarter, they beat by a whopping 87%. Those are big earnings surprises showing that something special is taking place at the firm, and yet the valuation is still ridiculously low. that spells great opportunities for us investors. Across nearly every dimension our system measures, this is a fundamentally rebuilt business that the market still has filed under legacy hardware. Across 115 different fundamental factors, it's A-rated. Again, this is the second highest ranked stock out of nearly 4,600. The forward earnings picture looks nothing like a stodgy 150-year-old company. That is the gap, and that is why it closes our stock list today. There you have it. 5 under-the-radar tech stocks, each with compelling growth stories, each severely undervalued, each waiting for investors to take notice and shoot higher. The question is, will you act before the market wakes up and the opportunity disappears? So please do consider whether any of these stocks have a place in your portfolio and then act quickly. Okay, the video holding up on your screen right now covers a different set of stocks our system has been flagging. That's because they have some of the strongest signals we've seen in recent months. That is exactly where you should go next.